Today, we're doing a deep dive. Our mission today is to unpack the real-world performance of this fully automated investment strategy called Hush, and we are examining their actual composite data through May 2026.
You know, we are just drowning in financial noise right now. Everyone has a hot stock tip or some macroeconomic panic narrative or a chart they swear predicts the future. So understanding how an automated, trend-aware, globally diversified portfolio navigates chaotic markets.
It's like a smart thermostat for your money.
A good way to put it.
Instead of you frantically running to the dial every time the financial weather changes on the news, the system just adapts for you.
Exactly. It takes the user error out of it.
But I want to look at the engine under the hood first. Before we get into the actual returns for May 2026, we have to establish how this machine operates. So looking at the Hush philosophy, it seems to be built on some strict parameters. First, they exclusively use U.S.-traded exchange-traded funds, or ETFs. And second, there is zero shorting and zero leverage.
And by restricting the universe to U.S.-traded ETFs, they give you global exposure without the friction and headache of foreign currency conversions. And by eliminating shorting and leverage, they can remove catastrophic risk profiles.
Because they aren't borrowing money to amplify bets.
And they aren't trying to bet on markets collapsing either. But the real core of this system, the actual algorithmic engine, is built on a concept called dynamic momentum.
Okay, let me stop you there.
Sure.
Because when I hear the word momentum in a finance context, it sounds like buying whatever meme stock just shot up 300% on Reddit and hoping there's a greater fool out there to buy it from you before it crashes. Okay, so how is dynamic momentum different?
Well, dynamic momentum, which was developed by their chief investment officer, Andreas Klenau, is entirely different. It is more like a freight train.
A freight train.
Yeah, it might take a minute to get up to speed, but once it is on the tracks, it is stable and hard to derail.
So how does that actually work mechanically? Like, what is the algorithm looking at if it isn't just looking for the fastest moving asset?
It measures the slope of the trend line, but it penalizes that trend for variance.
Oh, interesting.
Yeah. Instead of just looking at the 90-day absolute return, the algorithm asks, how healthy and smooth was the ride to get here?
Give me visual for that.
Okay, imagine two stock charts. Stock A shoots up 20% in a week, but the chart looks like an erratic heart rate monitor. You know, massive daily spikes and violent drops.
Just a total roller coaster.
Exactly. Now, stock B climbs 10% over a month, but the chart looks like a smooth, steady escalator.
Okay.
The dynamic momentum algorithm will actually rank stock B higher. Its risk-adjusted score rises because the trend is sustainable.
Oh, wow.
And stock A's score drops because the variance is too high.
I mean, that is completely counterintuitive to how retail traders act. The human instinct is to chase the volatility of stock A because that's where the excitement is.
Precisely.
Yeah.
And instead of just locking into one asset, the algorithm constantly reallocates capital to the strongest, healthiest markets while maintaining global diversification.
So it never abandons the core structure of the portfolio.
It shifts the weightings internally based on empirical math.
And you actually get to choose your baseline risk. Hush offers three different flavors, basically.
Yeah.
First, you have the Protector, which is the most conservative and holds the lowest amount of stocks. Then you have the Pure Global, also known as the Strategist, which is sort of the middle path balancing stocks and bonds.
Yeah.
And finally, you have the Adventurer, which is the highest risk, holding the most stocks for maximum potential return.
But the underlying dynamic momentum logic is identical across all three. The only variable is how much structural risk you, as the investor, are willing to tolerate.
So let's lay out the mandatory compliance disclosures. These are composite models applying the strategy's strict rules, not a single specific client's personal brokerage statement.
Correct. Second, the returns are calculated using a time-weighted methodology. Time weighting isolates the performance of the strategy itself.
Now, there is a third disclosure here. All the numbers we are about to discuss are net of fees. And this reflects a 0.75% annual advisory fee.
Exactly. The numbers we are looking at are exactly what the client keeps in their pocket.
But I do want to push back on something else. It's regarding the benchmark they use to measure success. They use something called the iShares AOR.
Right.
Why not just compare this to the S&P 500? I mean, if I'm an investor, I don't really care about some obscure AOR ticker. S&P is the default language of finance. Why shouldn't I benchmark against what my neighbor is buying?
Because benchmarking a diversified multi-asset portfolio against the S&P 500 is essentially an apples to oranges parlor trick.
apart.
The S&P 500 is a theoretical index of 500 large U.S. stocks. You cannot physically buy the S&P 500 index itself. It has zero transaction costs, zero management fees, and zero cash drag. It is a mathematical phantom.
But my neighbor isn't buying a phantom. He's buying a fund that tracks the S&P.
Exactly. He is buying a fund. And that fund has expenses. The AOR is an investable ETF, net of expenses. It is a real multi-asset fund holding global equities and bonds.
So it has its own internal fees.
Yes, and incurs real transaction costs. So, by comparing Hush's net of fees performance to the AOR's net of fees performance, you're comparing two assets you can actually buy in the real world.
You're forcing reality to compete with reality instead of competing against a theoretical index.
Precisely.
All right, the table is fully set. You understand the dynamic momentum freight train. You understand the double net measuring stick.
Let's look at the actual numbers.
Yes, let's look at what actual money did through May 2026. And instead of just reading a wall of numbers, let's look at the deltas, how stepping up the risk profile actually changed the payout.
Because the math played out exactly as the risk tiers were designed to.
Let's start with the most conservative tier, the protector. The protector locked in a trailing one-year return of and a since inception or ITD return of 25.6. But if you were willing to step up your risk tolerance and take the middle path, the pure global or strategist, you saw a massive jump.
Right.
The pure global hit a trailing one-year return of 24.5% and a since inception return of 34.3%.
Yeah.
And then we reached the top tier, the adventurer. It lived up to its name and scaled up even further. A trailing one-year return of 26.3% and a since inception return of 38.6%. So we have the scorecard. But a scorecard is just the final tally. What I want to know is how it got there.
The underlying trades?
Yeah. What was the dynamic momentum algorithm actually buying and selling in the trenches to generate a 38% since inception return on the adventurer? Okay.
This data tracks the individual contributors, the specific ETFs driving the portfolio's performance, and it tells a very clear story of the algorithm isolating winners and losers.
Okay, looking at the heavy hitters driving these portfolios up were XLK and EWT.
Right.
XLK is the Information Technology ETF, and EWT is Taiwan Equities. Those two sectors were doing the heavy lifting. But on the flip side, the bottom contributors dragging on the performance were USO, which is the oil fund, and ILF, which tracks Latin American and America's equities.
No.
Yeah.
So how did the Hush system handle that friction? Did it just sit there and bleed out on oil in Latin America?
Not at all. We can see dynamic momentum actively working. The machine aggressively leaned into the healthy trends and mercilessly cut the weak ones. Let's look at the adventurer tier's specific allocations. It recognized the smooth escalator of the tech trend and massively increased its weight in XLK, jumping from 4.8% all the way up to 9.95% of the portfolio.
So it basically doubled its exposure to the strongest asset.
And what about Latin America? What did it do with the ILF ETF that was dragging it down?
It systematically dumped it. It slashed its exposure to ILF from over 11% down to just 5.76% in the adventurer portfolio.
Wow.
The algorithm recognized that the trend slope was broken and the variance was too high. It pulled the capital out to redeploy it into healthier assets. That is the true advantage of dynamic momentum. It isn't that the machine has a crystal ball and predicts the future better than humans.
Right.
It's that the machine completely removes the cost of hesitation.
Okay, let's summarize the territory we've covered today.
Sure.
We've examined Hush, a fully automated ETF-driven strategy utilizing Andreas Kleno's dynamic momentum. It evaluates the slope and smoothness of trends to steer investments. They report under time-weighted returns that are net of fees, specifically a 0.75% annual fee.
Critical distinctions.
We saw how measuring against an investable ETF net of expenses, the AOR, is a far more honest benchmark than a theoretical index, and we saw the results through May 2026.
The proof is in the data.
The protector returns 8% on 1 year and 25% since inception. The pure global hit 24.5% on the 1 year and 34.33% since inception. And the adventure delivered 26% on the 1 year and 38.6% since inception.
But, I want to leave you, the listener, with a final thought to mull over.
Okay, what's that?
Andreas Klenow built the system on the philosophy that building wealth shouldn't be stressful. We've seen how the machine effortlessly scales into winners and out of losers. but it raises an important question about your own financial life. When the market inevitably panics, when the news cycle is screaming that the sky is falling and your portfolio is deeply in the red, what actually costs you more in the long run? Is it the transparent management fees of a disciplined, automated portfolio?
Right.
Or is it the psychological tax of your own human emotions, that internal panic that forces you to abandon your strategy, freeze in indecision, or try to time the market?
Thank you for joining us on this deep dive. Keep questioning the world around you. Keep looking for the signal in the noise. We will catch you next time.